Okay, welcome back. Here, I'm right now using sensible virtual trading. As you know, that the stock exchange doesn't allow virtual trading, so your virtual trading is, you get access using your Gmail or your account, your mail account. Uh, we'll be explaining how exactly to go to the screen, but right now I created an option expert particular position. Now what I'll do is, we'll be discussing some of the strategies. We'll understand right from buying a call. We'll right from buying a call to rest of the things. What we will do right now, the Nifty is trading at about 11,856. So let's say we'll take it as buying 11,900 call. Okay, buying 11,900 call. I'll just add. Now when I add, I get to analyze this. Now this is where the payoff chart, which I had actually shown you in the PPT, we'll see it in the real time how exactly the payoff chart shows, and we will use this to put various strategies, and let's see how it works. Now as of now, how does it look like? Okay, I have got into a position. I've got into a position. Let us go through this now. The premium which I have paid is 5,363. That's the margin also. That's a margin which is required. Uh, that's the capital required. Now the current market is at 11,852. For me to make money, break even, it's 11,972 is what I need exactly. So the maximum loss is very well defined here. 5,363 is the maximum, and the profits can be unlimited. Let us see. There are two aspects here. We need to know currently, as we're discussing, we're in the middle of the month. When I'm doing this video, I'm in the middle of the month. Already some amount of what should I say, premium loss would have happened, time loss would have happened. But let us still see. Let us still see. Even for the what should I say? Maybe I'll work on the next month premium also for better understanding. So let us see what happens at this point. So there first. Okay, I have taken a weekly. 19th October. Now let's say what happens as the time moves, as you know. So where I stand today, I happen to lose about 5,363. Now only I make money only when the stock moves beyond, as you know that, even to make up what I need to say that beyond 11,980. Now, based on if the market is going to go up by 2.5% to 12,100 plus, this is the kind of money I would be making. But as you can see here, the maximum loss wherever I stand, below this level, anything below this level, my maximum loss is restricted to uh, the premium which I paid, which is 5,363. This is how, if I buy a call, this is exactly the way. It shows. So this is what exactly we were discussing. This is how it is. Now let's see what exactly happens when I have to buy a put. So similarly, let me see if I can alter this. Otherwise, what I'll do is I'll add another trade. Let me buy a put. So let's say I take about 11,800 put. So what happens? So done. Now both the trades are in place. Okay, this is how the chart looks like. Now, any trade, as of now, it's 3 days to expire. I've taken a weekly option, and anytime it is 3 days to expire. Or for convenience, I can even go ahead and actually take it 29th. Similarly, even here, if it is possible, I would definitely like to. Okay. Here I have taken, now it has 10 days to expire. As you know that I have taken the month end contract, it has 10 days to expire. As you can see, these dotted lines are currently, this dark line is where with the currently this is where it is currently, the losses, but these are on expiry. As you can see that it will merge over a period of time. Okay, if the market remains at the current level of 11,880, like I'll be losing about 9,281. Only when the market falls below, as you can see here very clearly, falls below these levels like 11,680, I will make some money. Now let's try and understand this. Now premium I have paid is 9,281. That's a maximum margin. That's a maximum risk I have. And my maximum loss, my break-even point is 11,676. So anything below that only I'll start making money. Not until then. My profit is unlimited. Loss is minimum to 9281. This, if I'm taking a monthly position, I can actually take, if my based on my view, 22nd October. Let's see what happens to 22nd October. If I take a 22nd October, this is where it looks like. Okay. It's 11,800 put at 66.15. As you can see here, the premium changed to 4886. That's a maximum loss I can get. And if the market is down 2%, I end up making 11,500. Depends, whatever is your view. As you can see here, time to expiry as only when 3 days to expire, only by the time it expires. The maximum loss I can actually incur is 4,886 at any given point of time. And my break-even point, as clearly mentioned here, my big break-even point is 11,735. So below which I will start making money. And even if the market falls about 3-4%, this is the kind of money you can make. So always there will be, the loss is clearly defined, and the profit is not completely defined, as you know, when it comes to buying a call or buying a put. Only if there is a sharp movement, only if you're expecting a sharp movement, this works. Otherwise, as you know, the time value decay eats away your profits. Even let's assume, like, you're exactly at this level. Let's say you're at this level, but look at the losses. Basically, like with time value, with each passing day, you actually lose more money. Even the market remains at the same point, you actually lose more money only because of the time value. As it is clearly explained here, whether it is call or put, the time value eats away. Now, let's try and understand the next covered call. What do you mean by covered call? The covered call is actually call options are sold. A number of call options are sold will be determined by the investor's market view, which means if I already have a stock in hand, if I already have stock in hand, a physical stock or equity I have in hand, and then I sell the higher call option. Here, this I would like to explain in a different way. Here I would like to explain it in, let's say, okay, let us try and put these trades again. Let's say I have futures. Let us say I already have the current futures, which means to say I have the position, and then I actually sell a higher call. How does it work? Let us see. Currently, market, since it's trading around 11,850, I feel that it's unlikely to cross this 12,000 mark. Then I sell this option, call option. Now, what does it take now? Here, the premium which basically I've received is 2,704. The margin required is 1.67 lakhs, and profits again, it says not applicable. Maximum loss is also not applicable. This is the capital required. I have taken futures here. Now, what happens from this? Let's say I would. This is where I stand as of now. Anytime the market closes. My maximum profit is capped at this level, 12,514. My maximum profit is capped at this level, as you can see very clearly, but my profit max losses are unlimited. Like one, I have already received the premium, but here I would receive whatever premium I have actually received will be with me because it is close below, but I have to apply a stop loss here. Now, I explained this while somebody is holding stocks. Just for the example's sake, which I told you clearly, that if somebody holding stock, it's as good as, if the market closes anywhere below 12,000, then what happens? You actually get the premium and you get to hold the stock. Yeah, the whole idea. Or if you are taking a future, then obviously the stop loss has to be put somewhere based on whatever is your thing. Suppose let's say I would put a stop loss at about 11,780. That not more than 0.5% on downside, and this is the loss I'm ready to take. And if anywhere it closes below, as you can see, This is where 22nd October is the expiry date of the call which I have sold. In such case, this is the kind of money. So here you have a return on investment of about, yeah, even if the market moves up by 2.9%, as you can get, this is the return ROI in simple words. So this is the kind of money to be made, even if the market closes anywhere above, anywhere, as long as it closes above the level of 12,000, this is the kind of money you'll be making. Ideally, covered call, as you know, is usually done when you actually physically hold stocks. Now, let's look at a bull spread. What do you mean by a bull spread? Bull spread means, a call option is bought with a strike price and another call option is sold with a strike. It could be at a different, strike price. Maybe I go strike price, I'm going long at 120, but I'm going short at 150. This is what, let's try and see how exactly it works. Yeah. Okay. Uh, okay. Let me take the trade. I'm going long at a particular strike price. Let's say I go long at about current market. I go long at 11,900, but I also would like to sell because I feel that market is likely to close below 12,000. I also would like to go sell this. So now let's see how does the equation look like. Now net premium which I've actually received is about 2243. Margin required is only 19,000. It takes only 19.92. As you can see, the maximum loss is about 2243 right now, with a maximum profit of 5258. And capital required is not more than 22,000 as of now. Break even is as long as break even at expiry is about 11,930. As long as the market closes below 11,930, yeah, this is where you probably. But still, we have 3 days to expire. Now, what we need to do is actually let's look at when the market expires. Let's say it expires at this point, then there is a profit of about 758, and any closure above, you will end up, the maximum profit can be 5258, as you can see, by the time of expiry. And even your losses are clearly defined at 2243. As you can see, based on the movement, let's say the market closes anywhere, even if the market closes about 5% down, your loss is only limited to 2,243. But even if it closes anywhere high, I know the market definitely, but you make a profit of about 5258. And it also, interestingly, this also shows the positive, what should I say, profitability percentage is about 34%. So this is how it looks. Basically, this strategy is all about bull spread, as you could see. Now, let's look at a long straddle. What is a long straddle? Now, I'm going long at a particular price with the call, and at the same time, I'm taking a long call as well as a long put. Let us see, I'm expecting a sudden upwards movement. Sudden. Now, both it will be, let us say at 11,800, I go long and I add one more position, right? I also add a put at this. Now, this is how exactly a long straddle will look, where I have taken a call, as well as it's about the strategy is about buying a call and a put option with the same strike price. At the same strike price I put. Now I expect that market will have some movement. Okay. Now let me take it to the expiry. It has 2 days to expire. Let me take it to the expiry. What's the kind of investment? The total investment is 13,000, close to 14,000 rupees, which is the maximum loss. But the profit can be unlimited. Reason is, if you are expecting any movement less than 11,000, let's say you have any movement which is either less than 2%, less than 2% movement on the downside, and even on the upside, which is almost close to more than 1.5%. So if you expect that market to move beyond 12,000 or below what should I say, below the current levels. That's precisely below 11,600. Here is the range, 11,614 and 11,986 on the upside. Anything below 11,614, you actually make money. Anything above 11,986, you actually make money. But you already paid premium of about 13,000 rupees. You already paid premium to recover that kind of money. You actually for the break even. This is where it shows 11,440 to recover your premium on either side. On the upside, to recover a similar kind of a money, you need movement up to about what should I say? It should be more than 12,200 points, so about 12,200 points. Then you actually recover the kind of money. Now this is about straddle. Now let's look at a strangle. What do you mean by strangle? Buy a call option and a put option with the different strike prices. You're going to buy a call option and put option. Call option at a higher level and a put option at a lower level. Now let's say, again I move this. Again I move like buying a call option at 11,900 and let's say this also I'll make it into buying a put of 11,000. This is how exactly it looks like. This is what exactly it looks like. I have call option at a higher level and buying a put option at a lower level. Currently, since the market it's trading at around 11,850, so 50 points above I have bought a call and 50 points below I have actually bought a put. Now, where does it look like? Now let's see. In the range of 11,664 and 12,036, I actually don't make any money. In fact, I'm losing this money, where I'll be losing this maximum loss. And the capital required for this strategy is about 10.12. Now let's see that from wherever we are currently, the market closes 2% above at about 12,100. Then you end up, making about 4,763. Or from wherever it is currently, let's say the market is likely to close 2% down. To about 11,580, that's about 2%, let's say. Then again, you'll make about 4,763. That is the possibility. That's a possibility written on your investment. But since you've already paid premium, you're unlikely to actually make any money. You would not be recovering your money here in this strategy. So this was about the long strangle. As you could see, we have discussed straddle, we discussed strangle. Now I'll be going through what is called as a long butterfly. This is a beautiful strategy. It works in most of the conditions, but it requires application of mind and at what time you actually start the strategy. Now, if I'm doing this, it's ideal that there is enough time for the strategy to be made. Now, what you do is actually you are going to short a call. You're going to short a call at the same strike price, and you're going to take long above the strike price of call and below the strike price of put. Now this is how it this is how you create a butterfly. Now let's try and do this now at the same strike price. Let me choose the same strike price and take an action. Let's assume let me see. Okay, let's say since I've bought this, let me also, instead of buying, I'll make it selling. And selling of 11,900 at the same level wherever it is currently. And then I need to buy. Now together I have actually collected. Now let me make it into rather November. I'll take it for November 26th. Okay. Now here it is. When I'm doing this, 11,900 and 11,900, same strike price. Cumulatively, I've collected over 600 points of premium, 600 points of premium. So what I do is, I'm going to buy some 500 is about 11,400. I will buy 11,900, 600, 11,000. What I'm going to do is, I'm going to buy a call. Since I've sold this at 11,900, 600 is about 12,500. I can actually, it's not trading. Currently, there is not much of a volume or a trading in November because I chose November. I can actually go ahead and buy 11,500. As you can see, I'll buy 11,500 call. Similarly, I'm sure that it is right now it is illiquid. Similarly, 11,900 minus 600 is 300. So let me see if there is any volume. Yes, I'm going to buy this put. Yeah, I noticed it's not 22nd October. It is 26th November. Now, when I have to do this, I have to change to 26th November. Okay, the whole game changes. I'm sorry for the confusion. Now the whole game changes. Let's look at now the net premium received is 31,466. The margin required is about 45,000 rupees. And wherever it is standing currently, time value, look at time value, it has about 38 days to expire. Let's say the market closes at about 11,860 at the time of expiry. Whole time value, this is what we're talking about, whole time value decay, and you will end up with about 28,000 profit. Now, as long as the market trades between these 2 points, as you could see, these 2 points, you'll still be in positive. Now let's look at, until here is the range. As you can see here, 11,480 and about 12,320. Any trade which is below between these 2 points, you will make money. Yeah, this is exactly known as a long butterfly. As you can see here, it's a long, this is the long butterfly. So let's see, even the market closes 3% up from wherever it is, you'll still end up making about 4.8% return. Now the maximum loss is 13,534 and the maximum profit is about 31,000. This is how it looks. And then currently the capital requirement, the total capital requirement is about 93,000. Even though the margin required is only 45K, various premiums which you are buying end of the day requires that kind of premium. Okay. The beauty here is, when you know that the market is going to be a range between, as you can see here, from wherever it is currently trading, 3.8% up. It's close to about 4 point up, and then downside, let me tell you, up to about 3% down. Minus 3% or plus 4%, you will still be in the money. You'll still be making some kind of a money return on your investment as long as this strategy is in place. Here, at this time, I would like to tell you, let me tell you what happens. When it is at least 2 days, 3 days to expiry, I'm not telling you that, just go 1 or 2 days before expiry, you can actually look at the market price. You can actually look at the market price and exit, take the trade. Don't wait for it to expiry. What I would say, or even if you feel that, if you're whatever is your investment, whatever is your maximum profit, in that if you're seeing about 50%, sometimes it is better to grab it and actually pocket it. Because there are always so many trades, then whatever happens to the market, it should not matter to you. As long as if you're making about 50% of this, grab it and just take it home. It's a free money. Long strip is also about the same. You go long at the same point, both in call and put, which we have already explained. But what happens is, sometimes if you feel that, the quantity changes. Now, let me change the strategy. Let me change and say, let us try the long strip. Okay, 11,900 call I'm buying, and this is November 26. That's fine. Now, November 26, 11,900. I'm buying 2 quantities. As you can see here, you're going long 1 quantity, and you're actually going long put with double the quantity. Now, exactly that's what I have done. I have gone for 2 lots, and long I've actually gone with 1. Now, what happens here? Now, as you can see here, total premium it takes is about 72,000 rupees, close to 72. That's your maximum loss, but the profit is unlimited. Let us look at your break even. 11,421 is your break even on the downside, and I know the upside is 12,800 and 12,859. So you actually don't make money. You don't make money on the upside. You're not, your chances of making money on the upside is very limited. But if the market crashes anywhere, anything below this level of 11,420, you actually make good money. You actually make good money. As you can see, the market is going to crash about 5% from wherever it is currently. Possibly you are going to end up making good money. This is at the time of expiry. As you can see, the time value, how the time value plays. What it looks like, even if you are, even if you're going to be around this minus 1.5%, it looks like now you're going to be in profits. Even if the market is going to be down by 1.5%, you'll be in the profit if it's away from the expiry. But as it nears expiry, as you can see that this is the maximum loss is about 38,000 at this point, but the time value keeps you afloat. This is about, this is exactly about a long strip. And now we actually come to next part that is most important. We will be actually discussing about, let's say, selling a call. We will be looking at selling a call. What exactly happens when you actually sell a call? So this is how the graph, as you know, looks like. Now, what I have done is actually 26 November instead of 26. Yeah, let me look at 26 November itself. It has about 38 days to expire. This is where the current market, you're at this level. Yeah, currently we are at about 11,850. This is where the market looks like. Let me actually move this. Let me move this. If the market closes anywhere below this level, 12,240, as I can see, 12,250 is exactly the break even. Any close below that level, I make the maximum profit I can make is about 18,000 rupees. The capital required is about 1.35 lakhs. I get a premium of about 18,000. In fact, my profit is capped at 18,713. Now, when do I do this? When I feel that market is unlikely to cross 12,000 levels from wherever it is currently, from 11,850. I don't feel that it is unlikely to cross 150 points from this place by the time, right, November 26th. Then this is how it looks like. Now, this will be a return on profit of about ROI of about 14%, close to 14% is the maximum ROI I can generate. But the loss is limited. This is where you need to put a stop loss. Now, even before expiry, anytime before expiry, the only possibility is, you can actually, the projected loss definitely will be, yeah, if you allow it to expire, it's better. But anyway, if the market closes about 5% over and above, then it's better to actually close the position. It's better to take the position off, allow it to expire, and then your maximum loss is about whatever you would like to place. If you say 1:1 I'm playing, or if you don't want to lose, then you'll have to decide on your stop loss. As you already know, your break even, that's about 12,300, 50 points above 12,300. This is where I pegged my stop loss. But anytime during the losses can be more because of the time value. It carries more as you allow it to expire. In the last week, as you can go and close your position, but even if it's around 12,300, you'll only lose. See, at the time of expiry, you'll only lose maximum loss is about 3,700. But if it is away from the expiry, the loss, because of the premium, the loss looks much bigger. This is about selling a call, shorting a call. You short a call when you feel that the market has limited up move, but more of a down move. That is where you already kept your stop loss. You can afford to be from wherever you are. Even naturally, you look at. Let me see how I look at this market basically. From wherever you are currently, you are looking at maybe 1%, 2% upside, but rest you feel that the market is going to close down, then it makes chance. Then it makes sense to actually go with this position. That's about shorting a call. Now about shorting a put. So the 11,800 put I have shorted, which means when I short a put, which means the market is not likely to go down. It is likely to close anything above. Now here, when I feel that market is unlikely to cut below 11,800. Currently, it is trading at around 11,850. It's unlikely to cut below, but it is likely to close. So until what? Until about it gives me, as I've taken premium, how much of premium I have taken. Currently about 21,000 rupees premium I have taken. My loss is unlimited. If the market crashes, definitely it's unlimited. My maximum profit is 21,000. Margin capital required is about 1.31. Margin is only 1.1 lakh as of now. Now let's say from wherever I stand today, the market comes down by 2.5%. Then actually I've pushed it to zero. With the time value, you know that actually you're going to make loss with the time value. When I look at today, tomorrow's price, maybe a week from now, 15 days from now, yes, definitely I'll be in loss. But at the time of expiry, even if the market is closed by not down by 2.5%, I actually don't make a much loss. My loss will happen only below 11,515. Below that, I lose money, not until. But if it manages to close anywhere, because look, when I'm actually shorting 11,800, I'm very clear. 11,800, but I'm very clear. Market is likely to close above. So if that happens, you make about 21,000. That's close to about 15,000 return on your investment ROI. So it's all about your view, based on your view. Your view is wrong. Obviously, you'll be losing money, but you have about 2.5%. Even if you're wrong, you have 2.5% to correct yourself. Even if you are right, 2.5%, it comes down. Therefore, you don't lose money. The capital requirement is about 1.3 lakhs at this stage. So this is about shorting a put. Now, let's look at a bear spread. What do you mean by bear spread? Now, you choose a different strike price, like, one you were to short, a different strike price. Here what you do is, you buy and sell put option. You buy and sell put option with a different strike price. Now, what is your strategy? Let's see. You buy and sell put option with a different strike price. Now I'll add, as it is, I have 11,800. I'll add one more position here, 11,900. I'll also go and sell 11,900. You buy and sell put option with different strike price. Now, now this has to be okay. Okay, now my view is definitely bearish from wherever I'm standing currently. Now, if I feel that there will be closure, it will close below 11,820, then obviously I'll make my maximum profit is about 4,204. As of now, it looks like, my max loss is about 3296. My maximum loss is about 3296. What's the premium? Actually, this is the premium I have received. The margin requirement is about 21K, and this will offer an ROI of about 10%, close to 10, because the capital requirement is about 42K. My break even is 11,856. As long as, the market is about 11,856, below that, I make money. Above that, I lose money. But my losses are defined. My maximum loss is about 3296. But let's see how actually the time currently looking at the movement, even if it trades 3% down, immediately it doesn't look like you're going to make enough money. You should allow it by the time of as you can see, this is how the time value decays. As you can see, this is how exactly the time value decays. But since you have position on either side, it has a neutral effect. The time value has a neutral effect on this. So that is about a bear spread. Now, after a bear spread, it's about, we're looking at a short straddle. When you're looking at a short straddle, you sell a call option and a put option with the same strike price. You sell a call option and a put option. This we have already done. What do you mean by short strangle? Now, you sell a put option at a given strike price and a call option of a higher strike price. First, you sell a put option at a particular strike price and call option at a higher strike price. Now, what I do, put option, you sell a put option at a particular strike price and sell a call option, okay, at a higher strike price. Now at 12,000, this I would like to do at 12,000. What happens? Yeah, let's do it 12,000. This is exactly a short strangle. as you can see here, 26 November, I have chosen. As you can see here, now loss is unlimited. My maximum profit is capped at 40,000. My capital requirement is about 1.5 lakhs, and I've received premium of about 40,000 rupees. Now what happens here? Let's try and understand. So even if the market, let's look at market close. Where is this? It's about -4%. The market closes below 4%, I don't lose money, I still end up making money. Until about 11,263, I actually make money, even if the market moves up, let's say, even the market moves up about 5% from the current levels. Even if the market moves up from 5% from the current levels, I actually make money. So it's about 5 and 5. It's about 10% is what the width. You have almost taken the width of about 10%, but you still make up money. But anything beyond that, you'll start making money. But you need to, so that is where you actually need to put a stop loss. That is where you actually need to stop loss. But how do you do? How do you feel that you have to protect your downside? Make it a butterfly. That is, you buy calls. What you can do is, you actually can buy calls at beyond those strike prices. As you can see, you've almost got about close to about 600. If I'm not exactly, slightly below 600 points, you've got maybe outside these levels, possibly you can buy a call at about 11,000. You can buy 11,000 call, or you can buy a put and a 12,600 call. So when you actually do this, maybe you are even the risk is limited. That is where it actually becomes butterfly. As you can know, then that is where your loss is also defined. Your maximum loss is defined, but it takes additional little premium. You'll be shelling out some of the premium which you have received. This is what is exactly is about a short strangle. As I told you very clearly that what happens here, you buy call and put option with a different strike price. You buy call option and put option with a different strike price, and then you are actually creating a straddle. Uh, Even here, if I add two positions, as you can see, here, this is about buying a call and put option with a different strike price, and then a put option is sold. Put option is sold with a strike, with a straddle, and is bought with a strike, and call option is sold with strike. I hope these strategies were useful. As we went through, these strategies are useful. You can try more. What you can do is, when you actually add, what you can do is, you can keep go to the virtual trading and then keep modifying the strike prices and look for an optimum strategy. It is never, when you do it for the first time, it's never a wonderful strategy. But when you start tweaking, when you start understanding the various prices, somewhere the prices are unreliable, unrealistic, that is where you have an opportunity. Whenever you have an unrealistic pricing, that is where you either have an opportunity, in either taking it or entering. So based on which, you can make your strategies. This is the whole concept of strategies, doing strategies. Now, how you apply, how you implement it is all in your practice. This is what I say during the non-market hours. You spend about 30 minutes, 45 minutes exploring the strategy, first understanding the view. If the market is going up, market is going to remain sideways, market is going downwards. First determine that. After you determine, then look for a right strategy. Then look for the capital requirement and return on investment, a time frame, whether you're going to gain out of a time value decay or time value decay doesn't matter to you. So based on all those things, you actually start putting these strategies. Then only when you understand option Greeks, which we'll be talking a little later, option Greeks, then you'll know how to actually make it in your favor, how to make these strategies in your favor and generate a good return. Now, let me tell you, within the time frame of about 8 days, 15 days, maximum 21 days, you can create some amazing strategies which gives you a return of about 3% to 6% and 8%. Now, tell you, even the credit card companies, this is what I say, the credit card companies don't make so much of money. That's the kind of opportunity you have. Let's say that, maybe when you devise a strategy, it gives you a return of about 4, 5, 6%. Even at 50% levels, you actually take profits. At the same time, even when it is not in your favor, at 50% you cut off. I'll tell you, then also it makes a lot of sense. But then also having this strategy, I know you don't have to have it for longer period. If you're just looking at about 50% of your maximum profits or 50% of your losses, if you're taking money, it hardly in a week's time or less than a week's time, you can have brilliant strategies delivering you every time 2 to about 6 7% every time. uh, so if you manage to, even with a strike price of about strike rate of about 70% or 80%, you manage to lose twice but make about 7 to 8 times. I tell you that no one in India can make as much money as much as you can with these kind of strategies. So I wish you all the best and good luck for learning and implementing these brilliant strategies. Thank you.